Well, what a difference a few months can make. With March 2020 sure to go down as one of the most volatile months on record, with 3 interest rate cuts totaling 150 basis points in declines, this really is a once-in-a-generation kind of interest rate situation. With the markets in complete turmoil and our finances teetering on the brink, I would say tentatively that we have some light at the end of the tunnel. The next few months will tell us if this is the road to recovery or simply an oncoming freight train. So while we're not out of the woods yet, the markets have now seen 2 bank announcements regarding key overnight rates with no changes, and a modicum of stability has returned to the market. My name is Jim Leo. I'm partner of TVH Group, president of TVH Financial, and private wealth advisor at Raintree Financial Solutions. You are listening to the Tortoise and the Hare Financial Podcast, and in this episode, I'm going to be interviewing my partner Jon Sowerby of Verico TVH Mortgages, where he's going to provide a COVID-19 mortgage update and a summary of the last 90 days. Enjoy. All right, Jon, so we'll get this moving along. Why don't we start off with introducing yourself and providing a bit of a background?
Sure. My name is Jon Sowerby. I have been in the financial markets for a little over 20 years now. My career started on Bay Street with trading and sales for a major financial institution. I then moved on to the money management side and sales and operations for the next decade or so, and then put out my own shingle as a mortgage agent and then eventually broker in 2007, and that's where I've been since.
And you and I have actually been officially partners since October of 2008. And during that time, we were dealing with financial markets, dealing in chaos. Global markets were all over the place. So that was interesting in starting our partnership. Do you see any similarities from what happened back then to what we're seeing now because of the COVID-19 situation?
Yeah, and I would perhaps go so far as to say there are basic similarities in all financial crises and crises in general. And the first piece of the equation is, I guess, what they say: sell the rumor, buy the fact. So the first thing that happens is things start to go wrong, and people become concerned. And I think the first reaction for most folks, and a very basic human reaction, is you kind of hunker down.
Right.
And in 2008, I know when things started to go south on the credit side, a lot of individuals and institutions tried to batten down the hatches and make sure they were prepared for what they thought might have been the long haul. And similar situation here with the sort of charge being led back in March by the Bank of Canada with a series of interest rate drops, and how the general sort of debt markets and lending institutions responded, as well as how the government responded in attempting to sort of maintain that liquidity. So again, not unlike 2008, the first response was pull the horns in, protect yourself and your institution, and sort of see what happens next.
Right. And you and I are new to this podcast structure, I guess you'd say. I kind of launched it a couple of weeks ago, and I was getting into a series on my personal health situation and kind of tying that into having critical illness. But the reason why I put that on pause and wanted to interview you today was you do send out from time to time market updates or mortgage market updates to your clients. Mm-hmm. And recently you did send one out. So I thought it'd be a good idea to maybe go through that, because there are some people who love to read and there are other people who prefer to listen. So maybe we can kind of go through that email that you sent out, and there's some context behind it. You've already kind of touched on that, some of the moves that the Bank of Canada made recently. Can you get maybe into more specifics?
Sure. So things really started to happen at the beginning of March. I think it was March 4th, when the Bank of Canada, with a surprise interest rate announcement, dropped the overnight rate by 50 basis points. So to give you a little bit of context, normally the Bank of Canada makes 8 interest rate announcements every year, so roughly every 6 or 7 weeks. And normally 6 or even 7 out of those 8 times, it will be business as usual, and they will make no changes. So over the previous 20 years, we've had roughly 1.5 interest rate changes a year. And some years we've had no changes, and some years we've had 2 or 3, but on average about 1.5. And the usual standard is 0.25% or 25 basis points, either up or down.
Right.
So right off the bat, we have an unscheduled interest rate change and double the usual. From 25, they in fact went a full 0.5 percentage point, so 50 basis points. And that in of itself is not something I'd seen, I think, since I was on the trading floor back in the late 90s. So that is a pretty rare thing. Then 2 more times in the month of March, the Bank of Canada came out and dropped interest rates again, another 50 points each time. So all in, over the month of March, the overnight rate as set by the Bank of Canada dropped 150 basis points or 1.5%. This is really generational. This is not the sort of thing you see on any kind of a regular basis, and I would go so far as to say, at least to my knowledge, this was unprecedented. You probably have to go back to perhaps the times of the oil crisis in the late 70s and inflation in the early 80s to see sort of similar moves with interest rates. So we're talking the better part of 40 years.
Wow, that's significant. So then I guess people would automatically think, well, the interest rates dropped or the Bank of Canada rates dropped, so their mortgage rate must also have dropped. What happened there with the banks?
Well, it became a bit of a tale of two cities. We had people who had, for example, an existing fixed rate were unaffected because a fixed rate, by virtue of it being fixed, means no changes during the term of your mortgage.
Right. Variable
rates that were currently held by clients, however, did decline. And in some instances, I saw rates go down as low as, I think the lowest I saw was about 1.4%. So that's lower than inflation. So that's at a level that is almost beyond comprehension. That's essentially free money and then some.
Right.
But for people who were just coming to the point of obtaining a mortgage, the way things work is the banks will shift their pricing based on 2 primary drivers. One is their profit margin, and 2 is their risk profile. So the Bank of Canada, in dropping its overnight rates, is hoping to stimulate the economy and keep the flow of credit going. However, that's very much a theoretical. I mean, monetary and fiscal policy is largely, sort of the realm of theoretical. Practically speaking, you had those 2 issues front and center for the banks. So number one, rates were getting so low that they were unable to maintain their profit margins. So that was an issue for the banks. Add to that the fact that there was so much uncertainty, and the banks were very, very concerned about lending out money in greater amounts into what could have been a massive wave of business failures. Obviously, we've seen the impact of unemployment and the number of people who've applied for the CERB, et cetera. It simply didn't make them feel good. So what happened is, although the Bank of Canada was dropping rates, most lending institutions were increasing their rates. And what we saw was, in fact, in March, a real spike in most pricing mechanisms. And it, in fact, became more expensive to obtain credit instead of less expensive.
Wow. Well, and then today we're June 24th of 2020. So where are things at today as we stand right now?
So we had an incredibly volatile March, and is often the case, the storm, as it were, hit suddenly and fiercely, and then what we had were sort of a general calming effect. And I think we started to see, in Canada at least, the effects of the lockdown start to have some positive results. I think the term is flattening the curve. We had seen some success with regard to arresting the spread of the virus. That was definitely helpful. And on April 15th, the Bank of Canada had its regularly scheduled announcement and said that no change to interest rates. Now, what I will say, and this is reading between the lines maybe on my part, it very much felt like they were being hopeful as opposed to rooted in significant fact. Keep in mind, the overnight rate, they had dropped the overnight rate to 0.25%, so 0.25%.
Right.
So there wasn't a lot lower that they could go. And I think that at least a big part of that was crossing their fingers that we weren't going to see, a resurgence of the virus, et cetera.
Right.
Then we got into May, and with another month of general calm, and then we started to see that, yes, we were making some ground on the pandemic. We started to see a little bit more confidence infused in the market. Their next regular reported announcement came and went with, again, no change, but there was, in my opinion, at that point, more confidence behind their words. And what we've now seen is parts of the country gradually starting to open. We've seen the real estate market start to pick up. So some of the big drivers, I wouldn't say they're back online, but it looks like they're aligning to come back online. And I think that has generally helped the overall confidence level. I would say it's still somewhat fragile, but we've seen progress in that sense since sort of the initial disruption back in March.
Right. Okay. And at TVH Group, we haven't been able to find that crystal ball. What do you think happens next?
Well, I would say variations on the theme. There are essentially two ways this goes. There's a hoped for way, which is the curve continues to flatten. Something, fingers crossed, like a vaccine is ultimately nailed down, and we continue along the way. If that's the case, then now might be a good time for contemplation on what that means if you're trying to get into the market, because if things do go back to where they were, even 4 or 5 months ago, it was a pretty brisk market, certainly in most major areas of Canada. The opposite side of that coin is we have wave number 2, or we start to see the impact of the unemployment hit, and people are not able to return to work as quickly as they would like, or potentially work is not there to return to. And we have a bit of a drag on the economy, and it becomes significant. My understanding of the numbers from Ottawa is we're probably looking at somewhere around a $300 billion deficit this year and $1 trillion in debt for the country. And that's not the sort of thing that's going to go away quickly. The question, I think, is, do we continue along our current trajectory, see the pandemic hopefully fade into the annals of history, and get back on track and get to the business of addressing that through sort of general economic growth? Or do we have a further setback? Does $300 billion become $500 billion? Does $1 trillion become $1.2 trillion? Do we then sort of have to hit reset and begin at the beginning again?
Right. Well, for someone who might be listening right now, of course, they're going to ask the question, well, how does this impact me? And there might be different scenarios to consider. So let's start off with, if you're someone who's thinking of buying something right now, what should they be doing?
Well, I will say this. I think that we've seen a more balanced market for buyers.
Okay.
And that's not to say that it's become a buyer's market. In point of fact, while we did have a number of buyers drop out when the lockdown happened, we also had a number of sellers drop out. And I mean, if you think about that, it's no fun for buyers to be out and about, potentially exposing themselves to the virus. But by the same token, a lot of sellers didn't like the idea of people tramping through their property, and totally understandable. That said, the drop-off seemed to be rarely or more or less an equal proportion. And we still probably had more buyers than sellers. What I will say is, whereas perhaps on a desirable condo in downtown Toronto, we had maybe 15 bidders in January or February, we maybe went down to 2 or 3 bidders in April or May. So 2 or 3 bidders still says it's a seller's market, but certainly a far more balanced one. So for the buyers who do feel like this isn't necessarily the end times, this might be a point where they would consider getting into the market, because the reality is, if we do see things swing back to normal, there are prospects of picking up a property, and it's and let's be clear, they're not going to get a heavily discounted price tag on anything. I mean, if anything,
Right.
property prices have come up slightly, but they are perhaps going to get a chance to buy something in a less frothy market that's going to give them a better chance to pick up something at near to fair market value.
Right. Okay. And while we're on the topic of being a potential buyer, I know there's some changes that are coming down the pipeline in July in terms of how mortgages are going to be underwritten. I think there's some confusion there. So can you touch on that a little bit right now?
Yeah. So the first thing to be aware of is these changes will only impact people who are going to have an insured mortgage. And that means only people who are putting down less than 20%. So the first thing to know is if you're putting down 20% or more on the purchase price, this will not impact you at all.
Okay.
Secondly, it's interesting to note that what has in fact happened here is the Canadian Mortgage and Housing Corporation, a crown corporation of the Government of Canada, has tightened its lending requirements. So it is a bit of insult to injury for, all of those buyers who've been trying to get into the market, that they've now made it a little bit more difficult. And what they've done is they have lowered the allowable ratios on what they will allow for income qualification for a purchase. And again, only if you have less than 20% down. The good news is the other two major insurers in Canada, there's Genworth, the subsidiary of General Electric, and Canada Guarantee, who's owned by the Teachers Pension Plan. They have both said they will stick with current underwriting guidelines, which means that A, it's a potential from their end to pick up some market share, and B, it suggests that at least based on the two private insurers, the market fundamentals in Canada remain strong. Because normally when the Bank of Canada or the CMHC does something, you see the surrounding institutions in that area follow suit. This is a rare break with that protocol. So the fact that the Canadian Mortgage and Housing Corporation is lowering their tolerances for risk, but Genworth and Canada Guarantee are not, is, I would say, a good sign, and it reflects well on the overall fundamental stability of the Canadian real estate market.
Okay, well, that's good. Well, let's talk about then an individual who might look at investing in a rental property, second, third, fourth property. What should they be looking at right now?
So it generally depends on a handful of things, but one of the things I always suggest is if you are looking to multiple properties, the first thing to do is to have a conversation about the structure. I own a number of properties. My wife and I got into the real estate market many years ago, and through serendipity, lucky, if you will, things worked out not too badly for us, but Lord knows I made my share of mistakes along the way. And the one thing I will frequently say about real estate is mistakes are both expensive and time consuming to repair.
Right.
So one of the things I always suggest is first you want to do that diagnostic, set yourself up properly to proceed, and put yourself in a position where if you do ultimately find the property, you can move forward fairly quickly. Because my second point is, although it may take a while to find that property, when these things do happen, they tend to happen quickly. And especially given some of the volatility we've seen in the market, trying to nail down as many of the variables before you go to market and actually start making offers on properties is the sort of thing that's going to put you in a much better place, both in terms of your ability to be successful with your bid and in terms of your own anxiety level. Because let's be fair, if we're talking about hundreds of thousands or potentially millions of dollars in property that you're trying to buy, there's going to be some stress there. The more we can do to annex that stress from the process, the more comfortable we can make you with the process, the better your chances of doing something that are going to be ultimately successful.
Right. Okay. And what about that third person who is just looking to access equity out of their home? Anything different there they need to consider?
Lots of considerations there. Again, I've had a number of people, for example, come to me in the last few months, not surprisingly, with the idea that, hey, we're not going to be traveling this year, John, so we thought maybe it's time to finish that deck or get that pool put in. So the access of credit is the sort of thing that I have learned over the years that you want to try and start on sooner rather than later. And the one thing I will say is, given we are in a situation where banks have at least tentatively expressed some interest in reducing access to credit, if it's something you were thinking about doing, I would say good to get an application in sooner rather than later and
Yeah.
see what a lender would be willing to do, as opposed to going out perhaps and putting the deposit check down on that new construction project and then finding out after the fact that you were going to have trouble funding when you're partway through the build.
Right.
So again, the suggestion is get the file in sooner rather than later, get nailed down exactly what you can do, and then with that in hand, you can proceed as you think most appropriate.
Right. And when someone does an application, there's really no cost for them at that point, or really a commitment to purchasing anything or accessing credit. It's just more or less kind of doing the underwriting to see what's available, what they can access, if it's even doable. Correct?
Correct. I'm a big fan of putting the lenders in a position where they're beholden to us, and that's
Right.
typically what an approved file does.
Yeah.
The nice thing is at that point, we have no commitment to them. So if things change, if you decide not to proceed, if we find something with a different lender, we have the option at that point to change our tack.
Right. Okay. And then the final point in your email was basically what type of financing options should people be looking at? I know there have been times where you've said variable's probably better than, fixed term, or you kind of consider different terms. So maybe you might want to expand on that a little bit.
Sure. Well, I think the first thing I would say is it's really difficult right now. I think you'd have to try pretty hard to get a bad choice of term,
Right.
because money, generally speaking, is going to be at around the cost of inflation.
Okay.
And that means, range, so between 2 and 3%, depending on your choice, which is historically, once again, very, very low in Canada, certainly. Now, there have been times in the past where I have perhaps pounded the table, if you will, on one option or another.
Mhm.
Right now, variables and fixed rates are trading sort of very close together.
Okay.
There is a correlation between the two. So generally speaking, if variable rates move down, fixed rates will move down, and if fixed rates move up, variable rates will move up.
Right.
But it's not always 100% correlation. So what that means is they don't always move in lockstep.
Right.
And sometimes that creates opportunities. Right now, they're far closer together than they are farther apart.
Mhm.
So while I think traditionally, as someone who's done a lot of financing for himself over the years, given multiple properties, et cetera, I've tended to opt for the flexibility of variable probably more often than not. I think it'd be pretty hard pressed to say to someone that a fixed rate would be a bad option, just given that we really are sitting at more or less our all-time lows in Canada. So from my perspective at this point, it is far more about what the borrower feels comfortable with, as opposed to making a specific quote unquote play on the market.
Right. Okay. So before we wrap things up, is there anything else you'd like to add or discuss?
Yeah, I think in general, one thing, and it's something to consider that I have been suggesting to some of my clients who have been entering the market now, is that they may want to consider starting in a variable rate.
Okay.
In most instances, if you're with a good lender who has good terms, they will allow you to convert from a variable rate to a fixed rate at a time of your choosing with no additional cost and no need to requalify. So because we saw that volatility in March and had that huge spike in fixed rates, what we've seen since then is a gradual. So every week or two that goes by, and every little positive bit of news, like businesses opening up again, et cetera, sees fixed rates slide another 5 or 10 basis points lower. And we are now at a position, as I said, where fixed rates are starting to test the all-time lows, going back, I think, summer of 2016, if my memory serves, on fixed rates in general. That may well continue. But obviously, if you take a fixed rate right now, you would not have the ability to participate in that. Starting in a variable rate and continuing to watch that market might give those who have a little bit of appetite for risk. I don't think we're taking a massive gamble here, but maybe a bit of a calculated risk. It might give them a chance to leave a little bit less money on the table. And I've certainly had a number of clients give that some consideration, because again, the one thing I will say is we don't know where we're going, but the current trend seems to be towards lower rates. And I suspect with the overall fiscal and economic policy in Canada, that's probably going to be where we sit for the next while. And as a result, it might give us a chance to find a little more savings still. But in general, again, back to my original point, I think fixed or variable, it's very hard to choose a bad term right now. It is going to come down mostly to a function of what people are comfortable with.
Right. Okay, well, if a listener would like to reach out to you, if they have some questions or would like you to review their situation, what's the best way for them to reach out to you?
Happy to always take a phone call, or I know nowadays for some people, email is more convenient. So if they were to give me a call, my number is 416-488-0074. So again, that's 416-488-0074. Or a quick email usually finds me fairly fast as well, and that would be jon@tvhgroup.ca. So Tom, Victor, Harry, Jon, jon@tvhgroup.ca.
Great. Well, thank you very much for your time today. And if you're out there listening and you have some questions for Jon, please reach out to him. Thanks, Jon.
My pleasure. Take care.
Yeah. Well, there you have it. That was my recent interview with my partner, Jon Sowerby of Verico TVH Mortgages. Jon's mortgage license number is M08002811. His brokerage license number is 11946. You can also contact us at tvhgroup.ca. So that's www.tvhgroup.ca. And please look out for my next episode where I'm going to be talking about my life-saving open heart surgery and the emotional roller coaster ride that I went through along with my family. Take care.